interest rates have been coming down. During 2009 to 2013, we had high inflation. And therefore the RBI was raising interest rates, repo rate, reverse repo rates, consistently increased. After 2013, the interest rates have been coming down. And when interest rate comes down, the price of bond goes up. You might have studied that the relationship between inflation and the price of bonds. Interest rates and the price of bonds is inverse. When interest rate goes up, price of bonds come down. When RBI cuts interest rate, price of bonds goes up. And that is the reason why the returns from fixed income have been very high. In fact, in 2014, the return from the gilt fund, the fund which invests money only in Government of India bonds. It is supposed to be the safest investment. But in 2014, gilt funds gave a return of 14%, double that of banks. I was addressing the top people in the Federal Bank that year, and they were not aware of that. The returns from gilt funds, right? So it depends on the macroeconomics, on the central bank's monetary policy, etc. In India, a big change is happening now. Some mega trends are happening in India. GST is going to shift the paradigm in business. We are going to witness a transition of business from the unorganized sector to the organized sector. In many segments, unorganized sector players have been operating on tax arbitrage. That will not be possible under GST. Under GST, you have to be tax compliant, otherwise you are out of the system. It's forced compliance. So that's a mega trend that is happening in the Indian economy, likely to gather momentum going forward. Another major trend that is happening now, that has just started, and that is the financialization of savings. Savings are moving from physical to financial. 60% of India's savings, what economists call gross domestic savings, GDS, 60% of gross domestic savings went into physical assets like real estate and what John Maynard Keynes called the Arabian yellow metal. 60% physical assets, real estate and gold. Only 40% constituted the financial savings in the economy. Of this 40% financial savings, bank deposits, NBFCs, PF and pension funds accounted for 65%. Insurance is not investment, it is hedging your risk against uncertainties of life. Stocks and debentures accounts for only 8%. 8% of household savings. In America it's 52%. In Europe on an average it is 40%. Even in South Korea it is more than 30%. In India it is slowly happening, a big transition is happening. There are only 15 million demat accounts in India, only 15 million mutual fund folios, and there will be a lot of multiplication in mutual fund folios. 15 million demat account means only 1.5 crore demat accounts in a country in which the workforce income earners is 44 crores. As a workforce in India, 44 crores, 440 million. And this is only 1.4. That means bulk of Indians, vast majority of the Indians are not benefiting from the wealth creation which is being done by India's corporate sector. Since 1980, if you look at the performance of various asset classes, equity has beaten all other asset classes by a wide margin. Of course, equity is a risky instrument, highly risky. But let me tell you from my experience, the risk is only in the short run. If you have an investment horizon of 3 years and above, risk is very, very negligible. If your investment horizon is more than 5 years, the risk is nil. Of course, you will have to go through heightened volatility during certain times. That's the nature of the beast. But in the long run, this is one of the safest asset classes. I had gone through, as in my investment experience, I had gone through major crashes in the market, extended periods of volatility, assassinations of two prime ministers, communal strife, droughts, floods, war with Pakistan, earthquakes, tsunamis. But when I look back, I find the Bombay Stock Exchange Sensitive Index, Sensex, is around 410 when I entered the market in 1984, is now 32,000, right? So it is risky, but the risk is only in the short run. Heightened volatility in the market will impact the traders, not investors. For investors, volatility can be your friend. In India, Indian economy is in a high growth trajectory since 1990s. As we know, it was in 1991 India started on the path of liberalization. So if you take the last 25 years, 1991 to 2016, India has been the second fastest growing large economy in the world. Our average annual GDP growth during the last 25 years has been 6.5, second only to China. Now China is slowing down and India is slowly beating China in average growth rate. Since mid-1990s, mutual funds have outperformed other asset classes by a wide margin. Indian stock market has created phenomenal wealth, but unfortunately, the beneficiaries of this phenomenal wealth creation has not been Indians, but foreign institutional investors. I was reading the balance sheet of HDFC Bank, one of my favorite stocks, a company that has given me a lot of money, HDFC Bank. The stock multiplied 11 times during the last 10 years. 11 times during the last 10 years. In the bank, now you need 11 years for doubling your money. And I was reading the balance sheet of HDFC Bank, I felt very sad. Why did I feel sad? Because 74% of the equity of HDFC Bank is held by foreign institutional investors, including Harvard University Endowment Fund, Princeton University, California Pension Scheme. They have been smart to identify that these are going to be great companies. They invested. We watched the game. So that's why it is very important that you have to participate in this wealth creation. Foreign institutional investors and high net worth individuals in India, high net worth investors in India, a small minority have certainly benefited. But then we should have, even though financial inclusion is used in a different sense altogether, I believe that capital market is a place which can make growth a lot more inclusive. If ordinary people start investing to the mutual fund route, they will be participating in this great wealth generation that is likely to happen in India going forward. Closely look at this. The explanation is not required actually, it is self-explanatory. I have given here the returns from Sensex, returns from bank deposits, the returns from gold,